What is up, guys? Today we will be talking about dividends and portfolio growth. Have you guys ever wanted a sweet bedazzling car like this? I definitely have. Bro, that looks so nice. This can be possible for you and anyone, no matter what starting point you're at, in around 10 years. That's all it takes. It doesn't take 50 years. It doesn't take 100 years. It doesn't take 1 year, right? This is not a quick thing, but it's not a full-time life thing, right? So you can accomplish living off of dividends in 10 years. So what are dividends? Dividends are a payment made by corporations to the people who hold shares, representing a portion of the company's profits distributed, usually in cash. So if the company does well, they will usually be able to up their dividends throughout time. Not always, but sometimes. In order to be eligible for a dividend, you must own the stock before the dividend date and be listed as a shareholder of record. So you can't buy it the day before the dividend comes out and then get the full dividend, right? You have to be holding it for the whole year, the whole quarter, however long it is for that specific stock. Dividends are not fully guaranteed. Um, they have a payout ratio, and the higher that payout ratio is, the more dependable they are for getting that dividend. And lastly, they are taxable. Dividends are not something like super special like IRA outside of the tax brackets, right? If you get paid $100,000 in dividends per year, you're going to have to pay taxes on $100,000 per year. So you can't escape the IRS. The average dividend for this year is around 1 to 1.5%, and the average throughout all time is around 2.5 to 3%, as you can see here, which is a pretty good percentage, right? You could be asking right now, oh, well, my high yield saving account does 3.4% or 5%. Why would I ever need stocks with a dividend ratio? Well, the thing about stocks who also have dividends is that you can have that dividend quarterly and get profits that way, but the stock can also grow throughout time and you'd also have profits that way. So you'd have a double profit. So you might be getting minimum 3% per year from the dividend, but if the stock grows 10%, then you made 13%. So it heightens your growth. Um, and as it says here, some stocks, I've seen one stock offer like a 10% dividend yield, but that usually means that it's extremely risky to put your money in, and that sometimes you could lose a lot of the value that you have in the stock. Real versus nominal returns, okay? Everyone has to do or think of this math when they're in the market, dividend or not. But usually, if you are in a dividend stock, the dividend themselves could offset the inflation. So inflation needs to be counted in the equation of whatever you're doing to your yearly gain. Let's say if you make 10% this year on the stock market, if inflation went up 3%, you technically made 7. So you're still outpacing, but you're not making as much as you think you are. And a lot of people forget about this. This is very sneaky on the back end. So let's run through some basic projections. This is for, I'll do 3 different tiers, and then I'll change them in different ways so that you can see what would be the difference when it comes to the outcome if you're putting in more money, or if you're doing it for a more amount of time, or if you have a higher return rate. So there are 3 different variables we can mess with here, and we are going to see what you need to target when you are building your portfolio, and um, and what type of projections you would see with your portfolio. So this specifically is a 10-year This is the 15% return, 20% return on market, and 10% return every year. So after 10 years, you should have 100% or 150% or 200%, right? As you can see here, this one is more linear and the top one is starting to get exponential, which means um, that the higher rate that you can get from the market, the higher return, 20, 30%, the more exponential you'll get faster. Um, this is a very good example. This is 40 years, right? So this also tells us, because we have the same amount of return as we had here, except all we did was add time. Time can exponentially um, increase the value of your portfolio. So if you're starting at a 20-year-old, you have time on your side, you will be able to be more exponential than someone else who has started at 55, right? And it's good to start at any time, right? It doesn't matter. Don't worry if you're 55. Oh no, I've started too late. Don't worry about that, okay? You're starting now, and that's what matters. How can you build from where you're at now? So if you are at 55, time is not on your side, but you do have other things you can focus on. So time can help you exponentially in the long run because our returns never changed. And you can see at the top is top line, or the high projection is exponential compared to the others. For this specific line, we're at 20 years and a 15% rate of return on the market. And it is somewhat exponential, but it's a regular curve. So now we have 20 years with 25% back on the market. And you could compare the final number, right? You have 2.3 million versus 9.8 million. And you can see that the 9.8 million line is way more exponential from the curve right here. This is what you need to focus on if you're starting at a older age, right? If you don't have a lot of time, you need to focus on rate of return. That means that you need to get the highest rate of return you can possible. A lot of people put things into ETFs. Those have a lower rate of return, but they're safer. The higher rate of return that you're aiming for, the more riskier it usually is. So for me, I pick single stocks in my portfolio as an extremely high risk compared to ETFs with 500 different stocks in them. If one goes down, you're not really affected. If one of mine goes down, probably 5% of my portfolio is affected. So it's way higher risk, but I could also get more in the end, right? Because if half of your stocks go up and half of them go down in an ETF, you would stick at around 50%. Whereas if half the stocks go up and half the stocks go down, depending on how much I have put in those stocks, I would usually outperform an ETF on the market, right? As long as you pick really good stocks, right? You can't just be picking any of them out there. So, these are the three or four rules that I have put together when it comes to a um, uh, the portfolio growth over time, right? You will have, if you have a high rate of return, which means the market average is 10%. If you can get 15, 20, 30%, a high rate of return, it will make your returns exponential in the long run. So that means you would be making way more if you were competing against a friend who had the exact same amount of money, the exact same amount of time as you, but you made a higher percent of return by like 5%, you would be making exponentially, like we're talking 1,000 plus percent more than he would if we're talking like a 50-year range. If you have a high rate of time, that will allow lower returns to eventually turn into exponential long term. So if you're not good on your returns, but you have 60 years like I do, then you will still be able to have an exponential curve, right? You can have a 10% rate of return or an 8% rate of return. If you have 60 years, it's going to get exponential. So time is a very big factor and one of the most reliant ways, because then you could stick it in an ETF and be perfectly fine throughout the years. the amount you put in will not change the short term, but it will in the long term. So what I mean by this is if you put $10,000 in this year and the next year, you're probably going to get like $3,000 or $4,000 back a year, right? In returns. But if you keep stacking that money over and over and over, and you get, let's say, $900,000 throughout 10 years, then you'd have like a $2 million portfolio. So the that's where we get back into rate of time. When you first put your $1,000 in, that first $1,000 has time to appreciate all up until the last 10 years, right? So in the beginning, the amount you put in your account is not going to do much, but over time, it will do much. And the amount put in will carry the account short term, but in the long term, it is decided by the rate of return and time. This should be straightforward. And I'm experienced this in the public account right now. I have a decent amount of gains, but in the $55,000 that it is valued at, only I'd say maybe $8,000 of it was returns. So a lot of that, a massive chunk, over 70%, is me putting money into the market. Whereas years down the road, like 20 years down the road, I will have only probably put in like $700,000, but I would have $4 million. So right now, what's carrying the account when it comes to monetary value is me putting money in the account. Whereas in the long term, what will carry the growth and gains will be decided by my rate of return and the amount of time that I have for it to appreciate. So those rules will help you definitely, depending on who you are, if you have a lot of time or if you don't have a lot of time, and what you invest in. That's just a basic, I guess you could say, look through. I'm not really sure what word you would say for that. A basic terminology you could glance at to figure out where you need to be. Okay, so I decided to get 3 or 4 different examples from the average person who's making $50,000 a year, $100,000 a year, and $250,000 a year, just so that you guys can see what you would be able to make off of dividends throughout the years. So this is someone who's making $50,000 a year, which is average income. They're investing 15%, so only $625 a month, which is very doable. Assuming you're not outliving what you make, which is the number one rule in investing: make more than you spend, right? Or else you won't be able to invest. And we'll stick you at the average return of 10% and this year's average dividend yield of 1.5%. So after the first year, you're only making $124 a year, right? And you're like, what the heck, man? I can't even pay for like a nice pair of shoes for that. And you're right, you can't. One full year, 365 days, and you could barely pay for shoes. Whereas if you just let it compound, if you just wait and you're patient, after 5 years, you can pay a bill with it. You might be able to pay car insurance with it, right? And that's still not a lot, but if you just keep waiting, if you dedicate some time to it, by 20 years time, if you're only investing $600 a month, in 20 years, you could take multiple different vacations depending on the size of your family, but you get around $7,000 a year. That is a lot of money that you could help yourself with. So if you're still making 50K 20 years from now, you could be making 57K, right? And that definitely helps when it comes to living. And 50 years, I know this is a massive jump, but if you did this for 50 years, you would be able to live off of it. You'd be making the amount, if you're still making $50,000 in 50 years, you would be making more than you would be making at your job. So that is where time can definitely compound. This is a time compound example because our rate of return is average, right? If your rate of return was larger, and this is very, very conservative, I didn't want to put fake numbers together for you guys. I wanted you guys to see like the most realistic version of this possible, right? So this is if you don't crush the market, If you don't add any extra money into the account, it's only $625 a month, which is like $300 biweekly, which is not bad. That's you just saving money on going out to eat, pretty much, if you do that a lot. So for someone who is making $100,000 a year, this is above average. And let's say you're doing a 15%, you're putting 15% towards investing. You would be investing 15,000 a year, and you would be making around 1,500 on year 5 and around 14,000 on year 20, which is pretty much enough to where you can pay for a decent amount of your bills. And then at year 50, you're making stupid amounts of money, like $300,000 a year, bro. You can buy a supercar and be perfectly fine if you save up for like 2 years. So yeah, that's a stupid amount of money, and it compounds fast. So the more you can put in it, the more that you can have your rate of return higher, and the longer that you can keep it there, the more the more stupid your return will be or look like in the future. And that's for someone with $100,000, which is above average, but a lot of people can reach $100,000 in their lifetime. And this is for the high income earners, the $250,000 a year. And you can realistically invest 25% instead of 15 because your income's so large, right? So that's around $62,000 annually. Let's see here. If you, I think that's saying if you reinvest your dividends, you could have a whole bunch more, but we can get into that later. I'm pretty sure I do get into that later. By the first year, you already have $900, which is not bad at all. By year 5, you're looking at 5,000. Year 20, you can live off of this. And year 50, dude, you're making bread. Like, buy a yacht at that point. That's crazy. $1 million a year, and you could pretty much quit working, and you would get $1 million every year for the rest of your life, minimum. And if you don't even spend that $1 million, you could put it back into the account and get like 1.1 million next year, and then 1.2 million the next year, 1.3. So yeah, it gets insane whenever you are patient. So the drip, you might have heard of that before. That is a strategy where when you automatically get returns from a dividend, you invest it into the exact same stock that gave you that dividend, which creates a snowball effect. It's because you had, let's say, 10 shares, and then you got $5 of dividend money. Then you were able to afford 11 shares, and now you have 11 shares worth of dividend money for the next time instead of 10, right? So instead of leaving money out on the side or taking money, you put it back in to compound it, which that can also exponentially grow over a long amount of time. Right here, if you invest $10,000 over decades, it can grow significantly faster with reinvestment, sometimes 6 times higher than without investing. 6 times higher. That's a 600% increase over a decade, 10 years. 600%. That's over half if you just reinvest. So that is definitely the play. If you have extra money, or if the money you're getting from that account you don't need right now, put it right back into the account so that you can get that extra 600% gains over the years, which is insane. And a lot of you might ask, how long would it take for me to live off of these dividends? Like, how long will it take for me to get it? How long will it take for the average person to be able to quit their job and live off of them? And it's 20 to 30 years, assuming you have a 3 to 5% yield, which is on the high side. But you would usually need to get around a account worth of $1 to $2 million, which would be around $60,000 a year when it comes to dividend return rates. So it's very doable if you have a decent amount of time. And if you guys want to check out the video I just posted here, we talk about three different dividend stocks or two different dividend stocks that I've recently bought, even though the market's at an all-time high. I really do suggest that you check that out, because they will definitely, the stocks that I pick out in that video are at all-time lows while the market's at all-time highs. And the dividend rate is probably around 3 to 3.5% for those stocks. So you're getting a mega deal. Not only will you get the dividend rate from the stock, but I'm pretty sure the stock is going to double or triple over the next 5 to 10 years. So you're going to get the stock gains and you're going to have those dividend gains. But thank you guys for tuning in today. It has been an honor, and I will see you guys in the next one.